All right, well, happy Monday, everybody. It is October 24th, 2022. It is a very rainy Monday here in Manhattan. We are located on Madison Avenue, and we are going to be walking uptown tonight. We will be bringing the umbrella. But just a quick recap of what we're going to be talking about on the stream tonight. We had a pretty broad-based rally on Wall Street. The S&P 500 up 45 points to 3,797. The Dow Jones Industrial Average also had a nice rally today, closing up 417 points to 31,499. And then the NASDAQ Composite, following the two other major indices, up about 92 points to 10,952. So if you remember yesterday from our Wall Street to Look Ahead live stream, you knew that we were going to get a very, very key piece of economic data, and that's exactly what we got today. So we heard from S&P Global as they released their manufacturing PMIs, and boy, was it an ugly, ugly reading, okay? So the manufacturing PMIs fell off a cliff, coming in at 49.9, when the broad-based consensus on Wall Street, many economists were expecting a 51.2 reading. So coming in well below that neutral reading of 50, and even well below, or I should say further below, economists' expectations. If we shift to the services PMI, that also fell rather egregiously to about 46.6 from 49.3 the month prior. Now, we've been talking about PMIs on the stream for over a year now, and obviously you guys know that the first business day of every single month is when we hear from the Institute for Supply Management as they release their PMI numbers, okay, at the manufacturing sector. But S&P Global usually releases their numbers about a week prior, and in my view, what I like to call the PMIs, it's essentially the business cycle in real time. So I believe that the vast majority of people tend to make a mistake as it relates to interpreting the PMIs, right? The Institute for Supply Management PMI numbers. And the reason why I say that is because it's not so much the reading that matters, it's the trajectory of those PMIs. So for example, we had the stock market, the S&P 500, put in a top, I believe the exact date was January 6th. Now, if you looked at the PMIs, we had the PMIs actually top out in November at 58. Then we had decelerating PMIs every single month. We had 58, then 55, 54, 52, and you get the picture. So if you were to say, look, I'm not going to sort of reposition my holdings until the PMIs fall under 50, well, you're about a year late to the game. So we'll talk about that in a little bit more detail. Also, I do want to talk about the New York City housing market. I think you guys are going to be interested in that conversation. And then we'll talk about share buybacks. But for now, let's see who we have in the chat, and I hope everybody had a fantastic start to their week. Let me see who we have here. I see Love says, hey Tom. Aspillion, the one and only Buy the Book, is here. Andrew H. Jonathan Richards, the one and only British Gray from Tampa, Florida. I see Charlie Richardson. Ron McAllister, Eamon is here. Dre Parks. Roy S. Sweet Country Living in Michigan. Troy Atman Rocket. Horatio Snipes. Mimi and Lee and Ren 1018. All right, team, let us close the window here in the old WeWork office, and we will get to business. I do want to quickly show you guys a book recommendation. Well, I'm not going to recommend it just yet, but this is my new read here. It is called A Monetary and Fiscal History of the United States between 1961 and 2021. Now, the reason why I'm reading this book, let me just get out of this office. The reason why I'm reading this book is because I think it's more important now than ever to really get a full understanding and a good grasp of the history or the historical trends of monetary policy. I didn't even press the button. It's been that kind of a Monday. But the reason why I say that is because I think, you know what, hold that thought, because we always go dark in the elevator, so hold that thought. ABX girl, good to see you. So the reason why I'm reading that book, let me know if we're back on. We usually start to buffer. But here we are, team, on the corner of East 31st Street and Madison Avenue. So here's one of the reasons why I'm reading that particular book, is because I think it's more important now than ever to have a very, very deep understanding of the historical events of monetary and fiscal policy in the United States. Because if we have a clear understanding of the historical trends of monetary policy and fiscal policy, well, maybe we could have a little bit better idea of how we are going to weather this new monetary and fiscal environment. So I can't recommend the book to you guys because I haven't read it yet. I'm only about a chapter in and it is quite good so far. But the reason why I found out about the book, in all honesty, is because I follow a very famous economist on Twitter. His name is Mohamed El-Erian. And I respect Mohamed El-Erian very, very much. I think he's a brilliant guy. I learned a lot from him. And he recommended the book, so I went out and bought it. So that's the show. So I will let you guys know what I think upon conclusion. So D Wood is here. Says, you're back. Good to see you, D. I see my friend Dusty Cole. Good afternoon, Dusty, and happy Monday to you, my friend. I see Roy S., the one and only. Eric says, hey, Tom, have you read Confessions of an Economic Hitman? Ooh, Eric, I haven't, but that is on my reading list. I think somebody else in the chat had recommended that to me. But what about you? Have you read it? And if so, would you recommend that book, Confessions of an Economic Hitman? All right, check this out, guys. Just to give you a perspective of just how rainy and cloudy it is tonight. And I forgot my umbrella in the office. That's all right. Just to give you an impression of how rainy and cloudy it is. This is the Empire State Building, and you could barely see the top. I think you could see it a little bit. I'm not sure how it comes out on camera, but you could barely see it because it is covered amongst the clouds. Hey, I see Morris here. Good to see you. I see the one and only Dan Zhang says, hey, Tom, thank you for doing the stream in the rain. Dan, it's good to see you, man. So Dan, Discover Financial, ticker symbol DFS, they reported earnings today. Now, granted, the conference call is going to be tomorrow morning. It's at 8 o'clock. Now, I'll probably be on the call. I signed up. If you guys want to be on the earnings call as well, I would highly recommend it. All you have to do is go to the investor relations page of Discover Financial, punch in your work email, and you will receive a link, either a WebEx or a Zoom, and you can join the call. But we're going to go through some main takeaways from Discover's earnings report today. I think they reported a decent quarter, but there's some things that were a little bit concerning, which we're going to talk about. But overall, I think a pretty solid, pretty decent quarter. Now, one of the main things that I look for when major credit card companies are reporting earnings is the 30-day or short-term delinquencies and long-term delinquencies, because this will sort of give us a glimpse into the health of the U.S. consumer. Okay, are they able to pay their bills? Are they struggling with their minimum payments? So we'll talk about that. Also, we'll talk about some of the net charge-offs. But if you look all the way in the distance here, everybody, you're gonna see the One Vanderbilt all lit up. Eric says, Tom, I highly recommend it. Shows the international fiscal policy for the U.S. global dominance. Oh, wow. I'm definitely going to check it out. Guys, I apologize. I'm going to keep the stream on, but I got to go back to the office. I forgot the umbrella. So you guys will get to see the office again. But I got to go back and get the umbrella because it's going to rain pretty hard. And I think we're going to need it. But thank you for the recommendation. I'm going to check it out. So let me see what it is again. Let me read that comment. So Eric says, I highly recommend it. Shows the international fiscal policy for the U.S. global dominance. China has basically stole our playbook as of late. Thank you for that recommendation. Speaking of China, and I think I was actually texting back and forth with Dan last night and some of my other friends. One of my other friends is a trader in Singapore. But was anybody looking at the HSI or the Seng Index? I mean, talk about complete and total obliteration. I think at one point, the HSI was down 6%, Alibaba down double digits. Now, JP Morgan actually came out with a statement. Hold on, let me cross the street here. Usually when it just starts to rain, the cars have an issue stopping. So JP Morgan came out with a statement and said this China sell-off is well overblown and it could potentially present themselves with opportunities. But I'm not so sure. Look, maybe I'm wrong, right? But I think it's a little bit too maybe risky to touch a lot of these Chinese ADRs. Hey, Al Baker is here. Good to see you. Mike's has been away for a month or so, man. Great to be back. Hey, Mike, good to see you. Thank you for joining us. Vitzita Lopez is joining us as well. Good to see you. Warwalker says, I think it's a great idea. Yeah, I got to get the umbrella because I think it's going to start raining like crazy. And I don't want to get all soaking wet. Golden's Dawn is here. Good to see you. Welcome. Photos from around New York. Yeah, I'm not sure if you guys could see from the raindrops on here. But yeah, I got to go back in the office and get it. It should take us, 15 minutes. 15 seconds. I just got to get the umbrella. There we are. All right, so for all of those who missed the book recommendation, this is the new book I'm reading, and we're going to be talking about this once I finish it. But if you guys want to read it right along with me, it is called A Monetary and Fiscal History of the United States, and it was actually a recommendation by Mohamed Alarian, and he is a very, very famous, very smart gentleman who I respect very much. So I will be seeing how that book is and sharing it with all of you. Once again, everybody, I apologize. I forgot the umbrella, and it's usually we could do the stream without the umbrella, but it's going to be pouring. But this is a little bit of a look around the WeWork right as you get off the elevator here. This is the 4th floor. Steve, good to see you. Yeah, photos from around New York. That is the link to the book. Now, an interesting thing about this book, and here's sort of one of the reasons why I picked it up. Obviously, number one is because Mohamed Alarian recommended it, but also, Ray Dalio, who is really thought of as one of the greatest investors of all time. One of the things he says is that, in his experience, the best investors that he comes across are the most diligent students of history. Because if you study history and you understand it, sorry, I just got to get the umbrella cranking up here. If you study history and you understand it, well, you could find specific nuances and maybe even some commonalities between policymakers and different economic events and economic environments. So right now in the United States, we are dealing with very high inflation, and I would even say slowing economic growth. So high inflation and low economic growth, what does that remind you of? Well, maybe a stagflationary environment, right? Now, if we study history, how did the United States get ourselves out of that stagflationary environment? If we think about, the 1980s, we talked about this a lot on the channel. This is a pretty nice view, very unique view of the Empire State Building. It looks like a cloud is moving right through it as we're streaming. In March of 1980, the United States was dealing with extremely aggressive and entrenched inflation. And then former Fed Chairman Paul Volcker essentially took the Fed funds rate to almost 20% in order to kill inflation. But in the process, even though he was correct to kill inflation, in the process, the unemployment rate went to 10%. So in the current environment in which we're in, our unemployment rate right now is 3.5%. And the CPI print that we got last was about 8.5%. And if we remember from last week when we got the non-farm payrolls out, the unemployment rate actually went down. So one of the things that Fed Chairman Jerome Powell is looking for is for the unemployment rate to go up. So we were at 3.7, and then we went back down to 3.5. So this begs the question, and sort of is a little bit thought-provoking to all of those folks on Wall Street that is predicting a Fed pivot. Well, do we think the Fed's really going to pivot when the unemployment rate is going down? I don't know. We'll talk about it. But tonight we're going to be talking about Discover Financial. We are also going to be talking about S&P Global tonight. They released their manufacturing PMIs and their services PMIs, and they've really fallen off a cliff. So not good. Hey, JAC, this is beautiful view, Tom. Fun fact, the original Waldorf Astoria was the site where the Empire State Building now stands. Is that right? I never knew that. That's awesome. Thank you for saying that. Dark horses, things are coming that are so biblical. Well, I mean, I think if the bond market cracks and cracks hard, I think that is maybe the biblical event you're talking about. Millie is here. Says good evening. Hey, Millie. Good to see you. Dan Zhang says, I just found out today my friend's wife's uncle was one of the original employees at Alibaba. He sold all of his shares right after Alibaba went public. Whoa, that's insane. That's fantastic. Yeah, I mean, we were talking about Seng Index last night getting killed. And obviously this is in, maybe we'll walk up a little bit because I want to take you guys past the Morgan Library. But obviously that is in reaction to a lot of the political events that are going on in China, which are not very favorable. Let's just say that, not to get too political. But if we quickly just review that S&P Global manufacturing PMI. Now the number dropped to 49.9. This is from 51.2 that many economists on Wall Street expected. Now the services PMIs did actually even worse, falling to about 46.6 from 49.3 the previous month. So we continue to see the manufacturing sector deteriorate in the United States. Okay, let me wipe off my camera. Yeah, Austin City Limits, we're gonna have a wet lens like all the time. On the stream, it's raining. So I'll wipe it periodically as I can, for sure. But good to see you, Austin City Limits. Yeah, Adonis's bonds go down, rates go up. Yeah, I mean, that's why we've been talking about this over the past couple of weeks. We've been having, I would even consider, an uncontrolled sell-off in the debt market. You know, we've been having an absolutely historical move in interest rates. Now, the 10-year U.S. Treasury yield right now, I think, yields about 4.22%. So if you look at tradingview.com or any type of charting service, if you pull up a daily chart of the yield, again, not the bond, the yield, what's going on over here? Looks like there's a garbage truck stuck behind something. Yikes. So this is the Morgan Library. This is one of my favorite places in Manhattan. If you have not been to the Morgan Library yet, this should be one of your first stops when you come to New York City. It's absolutely gorgeous inside. But what I was saying about the US 10-year Treasury yield, I think we may have seen a short-term top in yields. Maybe. I mean, we are very, very well extended over the 50-day moving average, and the bond market has been selling off relentlessly almost every single day. So we could have a little bit of a bounce here, which could fuel this stock market rally. So the S&P 500, the NASDAQ, and the Dow Jones Industrial Average have now all completed follow-through days. And we've been talking about on the live stream that our first target would be the 50-day moving average across all the major equity indices. Now, the Dow Jones Industrial Average has already rallied above the 50-day. So I would say the next target is the 200-day moving average, and we're almost there at the S&P. The S&P 500 is almost at its 50-day moving average right now, but I think if we really want to look for a sustained rally, I think a couple things need to happen. I think the dollar, or the Dixie, needs to continue to come down. I think the Dixie right now is at 111. Now, you guys, you know, obviously have access to a computer. I'm out doing the live stream. So look at where the Dixie is trading at now. Obviously, the Dixie is the dollar index, which measures the relative strength of the US dollar versus a basket of other currencies. And the dollar has been absolutely monumentally strong, which generally speaking is not stock market positive. And number two, hold on, I just want to cross the street so I can give you guys a better view of the Morgan Library. This is one of my favorite places in the entire city, and I would highly recommend coming here. And number two, that I think would fuel the stock market rally, is if we get a little bit of a bid in the bond market. So if that 10-year US Treasury yield comes down a little bit, I think that could fuel the rally in equities to maybe the 200-day moving average, and then we roll back over, right? Depending on how earnings come in. So we are now at the front of the Morgan Library. Now, an interesting thing about the Morgan Library is there's also another museum, which we talk about a lot on the live stream, called the Henry Clay Frick Museum. Now, a lot of the, I would say, exhibits at the Henry Clay Frick Museum and the Morgan Library are sometimes passed around. So oftentimes when you come to the Morgan Library, they'll have exhibits and artifacts that are on loan from the Frick collection and vice versa. And if you guys are ever in the city, I think the two most underrated museums in New York City, I would say number one is the Frick collection, Henry Clay Frick, and number two is probably the Morgan Library. Now, I'll give you another shot from the other side of the street, facing north. Well, crossing north and facing south. Yeah, Rocket says, Tom, the Dixie is back at 2002 levels. It's been crazy. We've had a lot of dollar strength. Alex Berry says it's been very rainy October. Indeed it has. Good to see you. Ryan Beck says, ooh, New York City looking like Dallas tonight. Yeah, I mean, I think it's gonna rain all week here, everybody. Infinite Sky says hello, everybody. Cindy Foley is here, welcome. Good to see you, Cindy. So we'll walk down a block. I'm gonna have to be wiping the lens almost every 2 seconds on the stream. But I want to read you guys a quote. Can I do that? I think it's appropriate to do that now because we did get that S&P Global manufacturing data. So listen to the comment from Chief Economist Chris Williamson. And I think this is going to be very telling. And again, this is his words and not mine. And he says, the U.S. economic downturn gathered significant momentum in October, while confidence in the outlook also deteriorated rather sharply. And this is his response in reaction to those declining PMIs and the service PMI. So he says the U.S. economic downturn gathered significant momentum, and the outlook doesn't look too good either. And this is coming from the chief economist at S&P Global, Chris Williamson. Hey, Cindy Foley, thank you so much for the donation. This is 21,100 subscribers. Oh yeah, that's right, everybody. Really quick, before we continue on with the stream, thank you all for supporting the channel. I think we just reached 23,000 people, which is just mind-blowing to me. So I appreciate everybody being here. It's been a blast so far as we walk through New York City and Miami talking about the financial markets. So I appreciate you guys very much. So I want to know your perspective on this. It seems like month over month, we've been having declining activity in the manufacturing sector in the US and the service sector. Do you guys see this getting worse before it gets better? Or do you think we are very close to a turnaround or potential bottoming in the PMIs? Now, I think it's also important to take into consideration that on the first business day of the month, so next week, I can't believe October is already over, it's insane. We will be hearing from the Institute for Supply Management as they release their PMI numbers. And I think we're gonna finally get a reading below 50. We'll see. So Rich McNilla says we're probably gonna get worse before it gets better. Cindy Foley says worse before, unfortunately. Eric says just follow the market inflows. Ryan Beck says worse before it gets better. Flu's supposed to be very severe and overwhelming hospitals in some areas. So take that for what it is, says Ryan. So I think so I'm with you guys. So here's sort of my, I would say, perspective and thesis. And this is a ripoff of Paul Tudor Jones, Stan Druckenmiller, and Ray Dalio. I just want to show you guys this American flag. I always love spotting American flags in the city. Big fan of America. I think many of you are too. As it relates to the market, as of now, I'm in no position to start fighting the Fed. Now, many of you may say, wait, didn't we just have a follow-through day on Friday? And the answer is yes, we did. Now, here's my view on this most recent follow-through day. I think it's appropriate to probably risk, and this is just conversation between people. I'm not telling you guys to do anything. But in my money that I run, I think this follow-through day is warranted to test the waters or send out probes. If anybody's read Gerald Loeb's book, Battle for Investment Survival, he talks about sending probes out into the market. I think it's appropriate to risk 1% of equity on this follow-through day. What you don't want to do is risk 5% of equity or 10% of equity on a follow-through day in a quantitative tightening cycle. Because even if you have your parameters and you get stopped out at 7%, if you get stopped out, 3 or 4 times testing follow-through days, and you're committing 5 to 10% of equity on these follow-through days, you could have a significant drawdown in your equity curve, and that is not what you want. Now, to sort of take the other side and give both sides of the perspective, because I usually don't like to preach on the channel. I like to give both sides. We did hear from some of the Fed presidents. Oh, look at this dog. Beautiful dog there. Oh, look at them all. This is a whole, oh, and they all got raincoats on. This is cool. Nice. We did hear from some Fed presidents, most notably Mary Daly, who is the San Francisco Fed president. Now, she did come out with some very dovish statements. However, I'm not sure how much credence we should put into that, because she tends to be one of the more dovish Fed presidents anyway. So her perspective is this, and this is a beautiful view of Grand Central Terminal here from East 40th Street. It's fantastic. Her perspective is this: we should wait a couple of quarters to see what the effects of the existing rate hikes have on the impact of the economy. And at the next Fed meeting, which is going to be November, right? November 1st through the 2nd is the next Fed meeting. And consensus right now, if you look at the futures market is pricing in about an 80% probability of a 75 basis point rate hike. This would be the 4th consecutive 75 basis point rate hike this year, and in June of this year was the first 75 basis point rate hike since 1994. So before I was even born, I wasn't even alive. So you can really tell the aggressiveness that the Fed is taking. I would say the aggressive stance that the Fed is taking on monetary policy. To use Fed Chairman Jerome Powell's words and not my own, he wants to go big in an effort to not pivot too soon to make the same mistake that we made in the 1970s, which again led to the stagflationary environment. And it was very interesting to see Fed Chairman Jerome Powell up on the stage and use the terminology keeping at it. We have to keep at it. Now, maybe that was a little hat tip to the former Fed chairman, Paul Volcker, because his book that he put out before he passed away was called Keeping at It, which is a little bit of sort of relating to how he raised the federal funds rate to about 20% to kill off inflation. So, hey, Ed Dunkel is here. Hey, Ed, happy Monday. Good to see you. Says Powell doesn't want to make the mistake Volcker made. Interesting. Good to see you, Ed. This is Pershing Square right here. Now, Pershing Square is the name of Bill Ackman's hedge fund. Irish Dylan is here. What's next is the Fed was asleep at the switch and now they're trying to play catch up. Yeah, I mean, I agree with you. I think, so to what's next point, that's my main gripe with the Federal Reserve, right? Now, I try not to, when I do these streams, I try not to project my own political bias, because I think it's just better if I just present both sides, but I'm more along the lines of like a libertarian type, more conservative. So I'm actually part of, End the Fed, sort of that movement, I guess. But, the Federal Reserve, you'd be ignorant to say if they don't play a big part in the market. So I have to sort of cover it in a non-biased way. So I try to present both sides. I try to do a good job of that. But yeah, I think my main problem with the Fed is that for 14 years, we've been conditioning the economy and the global economy to operate in a ZIRP environment, zero interest rate policy environment. So once we take the candy away It's like a screaming baby. We don't know how to operate. We don't know how to operate businesses. We don't know how to hire people. We don't know how to function in an economy in normalized rates. So I think the problem is not the Federal Reserve raising rates fast enough. It's we've left rates low for too long. So I really don't know how they're going to pull this off. You know, some people talk about a hard landing, a soft landing. You know, I don't know how Fed Chairman Jerome Powell would pull off a soft landing in this environment. But hey, the rally car stacker says, hey Tom from Indiana. Good to see all of our friends from Indiana. Horatio Snipes says, Tom, love the new renovated MetLife building. Yeah, we may take a walk through there today. It's a really nice building. You know, maybe we'll do that. So let me walk to the end of the block here. I want to quickly turn around to show you guys the One Vanderbilt. And then we'll push on. But check out this view. This is the very famous Chrysler building in New York. Now, it's so cloudy here that you're not going to be able to see the top. I'm not sure how it shows up on the screen, or the stream rather, but it looks like a cloud is moving directly through the very top of the Chrysler. It looks amazing. Sort of looks like we're in a Batman movie here at Grand Central Station. And then this big building, you can't even see all the way to the top. This is One Vanderbilt right here. Okay, so we'll quickly just recap the S&P manufacturing PMIs for those of you who are just joining. So S&P Global released their manufacturing PMI for this month. The PMIs fell off a cliff to about 49.9 when the consensus on Wall Street, or many of the economists, were expecting a 51.2 reading. Now, services PMIs came in even worse, so even more bad news, coming in at 46.6 from the 49.3 reading last month. Now, I will say one more thing, because I think we've hit on this pretty good. Next week is already November. Oh my gosh. So, geez, where did October go? It's almost the end of the year. Can you guys believe that? That's nuts. That's nuts. We're in a simulation for sure. I give about a 60% probability that we're in a simulation. But maybe we'll talk about that in another stream. So we are going to hear from the Institute for Supply Management as they release their PMIs as well. And again, in my view, in my opinion, it's not so much the reading, it's not so much the number, it's the trajectory of those PMIs. So here's what I like to do, and if you guys want to do it too, I would highly recommend it. I would pull up an Excel spreadsheet, a blank Excel spreadsheet, and import all of the historical PMI data. And you could actually make a dot plot on your Excel model. And what you'll notice is it's almost like you're looking at the business cycle in real time. So the PMIs tend to peak and roll over in tandem or at the same time as the broader general market, such as the S&P 500, the Dow Jones Industrial Average, and the NASDAQ. So if I'm not mistaken, I believe in October of last year, we had the PMI numbers in the 60s, and every month since then we have been decelerating. So we've gone from 60 to 58 to 57 to 55 to where we are now. So the reason why I say you need to watch the trajectory is because if you watch CNBC or Bloomberg, they'll say, look, a reading above 50 signals expansion in the manufacturing sector of the US economy, and a reading below 50 signals contraction in the manufacturing sector of the US economy. So as a retail investor, you may say, oh, great, a 51 reading, this is fantastic, we're growing. Well, you got to look at the trajectory of that growth, right? Are we decelerating? Are we accelerating? And then you could, position your long-short portfolio accordingly. All right, so that's done. I will read you the comment that Chris Williamson, the chief economist of S&P Global, this is what he said in reaction to this egregious, abysmal, horrible, scary manufacturing report. He says the U.S. economic downturn gathered significant momentum in October, while confidence in the outlook also deteriorated sharply. So those were his comments on the report, and I would second that. I would second that. But this is the Capitol Grill. This is a pretty good steakhouse. There's also a location right outside the New York Stock Exchange. I see my good friend Dusty Cole. Treasure Maze says, hey Tom, I love these walks. Thank you, Treasure Maze. Thank you for being here. I see my friend Mike C. Mr. Cold says, I'm thankful for November. Mike, I'm not too sure about that. I think they do. My answer is going to be yes. I think they do the tours, the Statue of Liberty. Van is here. Says, hey, Tomcat. Thank you, my friend. All right, we got to do a quick break. I got to wipe the camera lens because it's pouring raining. So here's the good news. This is the last thing I'll say about the PMIs. Because at one point in time, this market will turn up, okay? I know things have been depressing. I know we've been covering horrible economic news. It seems like we've been just absolutely hammered by poor economic news, but it's gonna turn at some point. It may take a year, it may take 2 years, but we will have new bull markets. So just keep that in mind. So what we're probably gonna see is the PMIs will be in the upper 40s, maybe mid 40s. And once we start to see those PMIs go from 45 to 46 to 47, that's when you're probably going to want to get long here and get risk on, especially if the Fed signals a pivot. Now this could be later next year. This could be Q3, Q4 of 2023. But we will have another uptrend. We will. That's a guarantee. Hey, the Dark Horse, what's up? Always good to have you here. Hey, Crypto Guy is here. Says, this is a neat stream, found this yesterday. Now I'm officially a returner. Hey, thank you so much, the Crypto Guy. Appreciate it. So the Crypto Guy, I'll tell you a quick story since your name is the Crypto Guy. I had a press pass to the 2022 Bitcoin conference in Miami, and I actually got to meet for a brief period Dan Tapiero, which is such a humble and great guy, by the way. He's a great follow on Twitter if you don't follow him. I got to meet Orlando Bravo, which he is an absolute all-star entrepreneur. He is a Puerto Rican billionaire and the owner of Thoma Bravo, the private equity firm. Whoa, look at the rain coming down now, crazy. This is an absolute washout in New York. Good thing we went back and got the umbrella, oh my gosh. Could you guys imagine if we didn't get the umbrella? That would have been no bueno. So this is Pfizer over here. Wow. This is sort of like a pretty good ASMR, right? Don't worry, I have an oversized umbrella. I think we should be good. Aaron Frazier says, just what's the topic, just tuning in? So we have a couple of topics for tonight. We talked about the S&P Global Manufacturing PMIs and the Services PMIs falling off a cliff. But here's something else I want to talk about. Let's talk about housing for a moment. But if you guys are enjoying the live stream tonight, feel free to leave a like on the video and hit the subscribe button if you're new. But let's talk about the localized, I would say, real estate market in general in New York City. So I've been getting a ton of emails. So I guess I'll quickly tell you guys sort of what I do. I think I've explained this before, just to sort of keep tabs on the real estate market. But one of the things that I've been doing is creating a separate email account just to go on Zillow and highlight all of the properties that are in my price range, right? So it doesn't matter if I like the property or not. I just want to be highlighting every single property in my price range so I can get an email alert anytime there's a material price change, anytime an apartment or a home goes under contract. I want to get that notification. So I went through my spam email box today, and you would be surprised by the amount of apartments that have price cuts here in New York. There is a lot of apartments that have price cuts. And I'll give you a couple examples of that. Now, before I give you a couple examples of that, whoa, look at it's almost like a river coming through here, man. Look at this. Now, here's one thing that's bad about New York City. When it rains here, it rains like in buckets, and it can overflow the storm drains. So that's why you always see, after huge rainstorms in the city, you'll see the Hudson River being all nasty and brown because a lot of the sewage plants could overflow. Photos from around New York says condos or co-ops. Both. I've been seeing both. So photos from around New York, I actually wrote down a couple of the addresses. Now, I'm going to give you guys the addresses of these apartments, but I'm not going to give you the exact apartment numbers. I don't think that's a good look. I'm not a real estate agent, so I don't feel comfortable just putting these properties on blast. But the reason why I'm detailing it is because we have a lot of viewers who are first-time home buyers or first-time apartment buyers. And I think next year you guys are going to get some really good deals. Very good deals. So let's sort of take a step back and understand why we think these price cuts are happening. Now, could it be seasonality? Maybe. I understand that. I'm trying to sort of take in consideration all of the arguments here. Could it be a seasonal thing? Perhaps. But I think it's an interest rate impact. Because this time last year, the 10-year U.S. Treasury yield was yielding about 3 to 3.25% on a 30-year fixed. Excuse me, not a U.S. 10-year Treasury yield, on a 30-year fixed. It was yielding about 3.25%. According to Bankrate.com, as of today's close, October 24th, the average fixed rate mortgage on a 30-year fixed is 7.25%. So think about that for a second. If your price range for a one-bedroom apartment in New York City is anywhere between $600,000 and $800,000, you know, with a 20% down payment and you're financing the rest, that's a big difference in your payment between a 3% and a 7.25% interest rate. So what I think you're going to see, and again, this is very opinionated, so I always like to give a forewarning when I give opinionated things. I think if you were looking for a home, if you're a first-time home buyer, apartment or whatnot, I think not only are you going to have better negotiating power, so I guess you could call that a buyer's market, I think you're also going to be going into a market with declining prices. And I think the best of the deals are going to happen in Q3 and Q4 next year, with the real price declines starting in Q2. Wow, check out the One Vanderbilt as this rainstorm moves away from us. Hey, Carol Williams is here. This is good night, everybody, from Antigua and Barbuda. Thanks for coming. Ryan Beck says, Tom, December, January, and February will show the real pain. Yeah, I mean, potentially. I think you're right. Edwards is in what price range are you seeing price cuts? 500K to 1 million. I'll tell you right now. So I'm going to, I took some notes and I wrote this down for you guys because I wanted to share it with you. So just bear with me because tonight is a very rainy night. It's downpouring. I got the umbrella in one hand. So let me pull out my notes. I actually wrote down because I get all these emails, right? And I've probably gotten 25 emails with price cuts. So I'll read them to you guys now. Hey, Lou72 is here. Says, hey, Walk Small Street, good to see you. Good to see you as well. Thank you for joining. So here's the first price cut that I saw. So the address is 175 West 73rd Street. It's about a $30,000 price reduction, and it's a 1-bedroom, 1-bathroom apartment. And I think the price range was about $500,000. Now, I wrote down an example, and that's just one property. But check this one out. This one is 500 West 43rd Street. So if we walk up one block and go all the way to the west side of Manhattan, that's where that building is located. So this specific unit had a $55,000 price decrease. So with the 20% down payment, so what's 20% of 880,000? Like 170 grand, 176? So with the 20% down payment on an $880,000 1-bedroom, 1-bathroom property, with just the principal and the interest, this is not the property taxes, not the HOA, with just the principal and interest, assuming a 7.25% interest rate, your monthly payment is going to be $4,836. Now, I mean, obviously that's just not sustainable. That's wild. You know, if you add in your HOA fees, which is probably, you know, $1,000, maybe $950. I mean, you do the math. I mean, you could have a mortgage payment of 6 to 7 grand on a 1-bedroom, 1-bathroom place. That's just not going to fly. So I think you're just starting to see these price declines come here. I think it's going to create very good opportunities for anybody looking to buy down the line. But so far from what I'm seeing, and let me know in the chat, what are you guys seeing in your neck of the woods, right? I'm just giving you some anecdotal data from here in New York, but what are you guys seeing where you are? Are you seeing price declines? Are you seeing homes sitting on the market for longer? I would love to know your perspective. If you want to type it in the chat, and just please give us what city you're from. All right, but this is under Pershing Square, and this is the front doors to Grand Central. Eric says, Tom, I'm seeing price cuts across the board in Utah. Mike sees $7K for 1-bedroom, 1-bath is nuts. Yeah, I mean, you know, even if you're looking at a 1-bedroom, 1-bathroom for like $500,000, you know, once you factor in the HOA and the property taxes, you could be paying up there to $5,000. I mean, it's definitely not unrealistic. D says, Tom, our HOA is worth it? In my opinion, no. Ryan Beck says, Tom, it's still a catch-22, right? The average percent interest rate of homeowners is like 4%. What will make them move or force them to sell? That's a really good comment. So Ryan Beck, hold on, the chat's moving a little fast. Ryan Beck makes a really good point. It's a really good point, actually. Julia M says, Tom, how is Florida? I'm seeing the same thing. I'm seeing a lot of the rentals come down a lot. Maybe even a little bit more than New York, actually. Norris says, here in Wisconsin, homes are still selling very quickly. Some of the small towns can't even get a viewing before they are contingent. Wow. Thank you for sharing that. The dark horse is Charleston, South Carolina, booming value because all the New York City people are coming here. All right. Lou72. Jared is here. Says, Tom, with the figures you've described, you can live in Miami and get a lot more for your money. In general, South Florida is very attractive right now for real estate. Yeah, so I own an investment property in Southern Florida, but I think generally what I will say, Jared, is that I think property values are going to come down. Now, that doesn't mean it's going to happen. That's just sort of my worldview. But you make a good point. Southern Florida is, you get a lot more bang for your buck, you're right. Sean says, surprisingly here in Atlanta, the gas is dropping, but a one-bedroom apartment is still like 1.5K. Yeah, so the interesting thing, and I think it's important to explain all the facts. So what have we seen? So last week, and we actually dedicated a stream to this, by the way, but we heard from the National Association of Realtors as they released their existing home sales data. Now, transaction volumes across the board are falling, right? Because higher interest rates prices out a lot of people from the single-family home buying market. But to a lot of people's point in the chat, and you guys are making a good point, the inventory is still very low. That's a fact. So I try not to cloud my bias, because my view is, look, I think real estate's going to come down, but I think it's also important to really hit on the pieces of data that conflict with my worldview, right? I don't really like to be surrounded by confirmation bias. So that's right. I think we have about 3.5 months of supply on the market right now. Now, top real estate experts will tell you that in order to find an equilibrium or a balance between buyers and sellers, you need about 6 months of supply on the market. So we're at about half that. Hey, Who Dat Davis here. This is Tom. What do you think about the reports that we have a 25 days supply of diesel fuel in the United States, the lowest since 2008? Well, I think that's in relation to the strategic petroleum reserves, right? I think the Biden administration has been releasing a lot of the reserves to in an effort to get oil prices down. Now, the interesting thing there is, did anybody see the statement that the White House put out saying that they're planning on filling back up the strategic petroleum reserves at $77? Did anybody see that? All right, guys, so this is the Grand Central Terminal right here, but I want to give you guys a little bit of a recommendation. So if you're in New York City for business, if you want to impress a client, you're taking them out for drinks or something like that, take them here, okay? This is called the Campbell Bar, and I want you to go inside the Campbell Bar and be seated all the way on the right side. So if you want to know what I'm talking about, let me just wipe the camera. If you Google Campbell Apartments, NYC, and you look at the Google images, you'll see what I'm talking about. It's absolutely beautiful in there. And I've taken many clients here in my day, and there's a lot of rich history here, and the architecture and the ambiance is bar none. So if you're in New York for business, you want to impress a client, take them here. All right, so I'm going to close up the umbrella. I'm going to get dry for a minute, and we are going to go inside the Grand Central Terminal just so I could take a break, and I'll show you guys the ceiling in here. Hey, Rich K says, Tom, will you use Grand Central Madison when it opens? Yeah, Rich, I'm actually really excited for that. So what Rich is talking about is, it's called the Long Island East Side Access Project. So here's the Campbell Bar. But what I want you to do is don't sit out here, sit inside. Okay, that's the Walks on Wall Street tip. If you're trying to close a deal, get some big transaction done, go inside there. So what I like to say, if my umbrella would stay closed here, I think that's bad luck if an umbrella opens inside. So the Dow futures are probably 500 points in the red right now. So apologize in advance. But the Grand Central Madison is the Long Island East Side Access Project, which will allow Long Island Railroad customers to get off right here at Grand Central Station which I think is great. So I think the MTA is doing a good job on it. I think it's been a long time coming. But the problem is that it's taken, I would say, maybe 2 or 3 years behind schedule, and they still haven't announced an official open date yet.
Discuss your thoughts, concerns, and suggestions about anything and everything that you want.
Yeah, Mike sees like Tom Tanks Economy. Hilarious. All right, I'm gonna show you guys one of my favorite spots in Grand Central, but first, so you can see everybody running to the train. So Grand Central Station, you can get the Metro North, which will take you to upstate New York. Now, I've only been on the Metro North one time, and that is to take the train to Ossining or Ossining. Does anybody know how that's pronounced? I think it's Ossining. But check out how beautiful the ceiling is. Okay, so David says they're advertising it for the year end. Yeah, I mean, David, I saw that too, but the interesting thing is they said that last year as well. But look, I'm gonna be optimistic about it. I will definitely take the East Side Access Project because oftentimes I work right here on Park Avenue, so. And I think that's gonna entice a lot of people to return back to the office too. Because let's say if you work on Wall Street or something like that, the reason why I'm using that is because, just an example, Park Avenue is the real Wall Street in New York. Now, obviously, where the New York Stock Exchange is in Lower Manhattan on Wall Street, but many of the investment banks, the hedge funds, private equity firms are actually here in Midtown East, on Park Avenue, Madison, things like that. So, if you're commuting from Long Island, right now you have to go to 34th Street, Penn Station. Then you have to take the train all the way to Times Square. You have to take the shuttle to Grand Central and then go to work. So I think it's going to be a lot more efficient with the East Side Access Project. My favorite thing of all time in Grand Central Station is the chandeliers. Take a look at the detail. Amazing. Yeah, John says the chandeliers are nice. Hey, Mr. Remy is here. Says, hey, Tom. Used to work at Citco, fund administrator on Park. Hey, cool. So how did you, were you commuting from Long Island? Or were you commuting from, or you did just live in the city? But yeah, I mean, look, I think it's going to be very convenient for Long Islanders. I think and don't quote me on this, but I believe that the number one commuter, I would say the populace of commuters come from Long Island that commute into the city, even more so than the Metro North and New Jersey Transit. So I think it's good. Okay, you commuted from Long Island, yeah. So I'm Massapequa, so South Shore, Long Island, so. Yeah, Edward says, open your umbrella again. I've started a short position on S&P 500 E-mini futures. That's funny. It's hilarious. So yeah, I guess I'll read you guys. So I told you what I usually do to just keep tabs on the housing market. Expect real estate prices not to decline if you have a mere 100% increase in rates. So we went from about a 3% 30-year fixed mortgage this time last year to, I think today, according to bankrate.com, the average 30-year fixed is 7.32%. So one of the things that I like to look for first, oh, I'm going the wrong way, apologize, is existing home sales data. So we've been covering existing home sales data on the stream almost every day. It was weird. On the stream almost every month, when it comes out. And we've been having 6 months of straight declines or deceleration in home sales, which is to be expected, right? So usually how the housing market works is you don't automatically see price declines. Okay, what happens is transaction volumes, you could sort of, I like to picture like a spigot, and the spigot turns off, because if you're listing your house for sale on the market at $600,000, just because your neighbor, you're like, but my neighbor Tommy sold his house for $600,000, and it's the same square footage, it's a 3-bedroom, 2-bathroom, it's the same house. I might as well list my house on the market for $600,000. It has to sell. Well, what you're not taking into consideration is your neighbor sold their home. Yeah. Okay. Your neighbor sold his home when interest rates were 3%. Right now, rates are 100% higher. So to put this into perspective, 20% down payment on an $880,000 piece of property is $176,000, right? With a 7.25% interest rate, just the principal and the interest alone is going to make your mortgage $4,800. That's not including the taxes. That's not including the insurance. So that's going to price out so many people from the market. And once these homes start to sit on the market for maybe 40 days, 50 days, 90 days, that's when the real estate agents that these buyers are working with, they say, look, this home is sitting on the market for way too long. It's not a good look. We need to start the price reductions. And I think we're starting to see that now. I've been getting emails from Zillow almost every single day with price declines. $30,000 price decline at 175 West 73rd Street, another $35,000 price decline at 7 Park Avenue, a $49,000 price decline at 535 West 110th Street, Cathedral Parkway. And these are all 1-bedroom, 1-bathroom homes, 1-bedroom, 1-bathroom apartments in the range of about $550,000 to $750,000. So I think we're making progress. I think we are making progress. Brad's Brain says, I just glanced at home prices in Houston area and still see quite a few reduced. Yeah, now to be clear, I'm not predicting, I don't think we're gonna have a cataclysmic meltdown like we did in 2008, mainly because the underwriting standards are a little bit better this time. There's a very small portion of, I would say, homeowners that have ARMs or adjustable rate mortgages. And also, if you do have an adjustable rate mortgage, the ARMs or the adjustable rate mortgages of today are very different than the adjustable rate mortgages from 2005 leading up to the great financial crisis. So I think that we'll probably see broad-based declines across the board, but I don't think you'll see like the 50% cataclysmic meltdown as of '08. But this is the very famous clock here at Grand Central Terminal. But my favorite is the big American flag hanging from the ceiling. Nelson Sanchez is here. Hey, Nelson. As I recall a few Monday nights back, it wasn't as busy as it looks tonight. Yeah, I think you're right. The city does seem pretty busy. Now, I will say, since a lot of the colleges and universities are back in session, you talk about NYU, Columbia, it seems as if a lot more people have been coming back to the city, which is good. That's what we want to see. Julia M says, will rents go up? So I think at first you had that dichotomy of everybody being priced out of the buying market all at once, and then all of them rushing in to the rental market. So you've had about a doubling in the pool of renters, right? Because if your budget, let's sort of play this out. Let's say if you're a first-time home buyer, your budget's around $400,000, and you determine that budget based upon a 3.5, 30-year fixed. Well, that budget needs to be totally redone for 7% interest rate environment. And now if you run the numbers, if you buy a house today, you're probably better off renting in the short term because prices have not adjusted to the rate rise as of yet. So, I mean, play this through with the example I just gave, right? There was an $880,000 property here in New York. with 7% interest rates, not including HOA fees, not including taxes, not including insurance, your monthly payment's $4,800 for a 1-bedroom apartment. Go rent it, dude, for $2,000. Why are you paying $7,000 for it? Anyway, so I think it's going to come down, and I think this is going to present fantastic opportunities, also for us multifamily investors to buy pretty good cash flowing real estate. Another thing I wanted to mention, and are you guys seeing this? Maybe somebody who's watching the stream actually has experience in real estate development. Maybe you work at a single family home builder, something like that. Are you seeing single family home builders as of now potentially get in trouble and stuck with, let's say, 200 to 300 homes? A lot of their clients could have potentially canceled their orders or reneged on the deal because interest rates and uncertainty in the economy. Now all of these single family home builders potentially, and again, this is just a scenario, could have a lot of supply. They could be sitting on a lot of supply. So they may go off to the big PE funds out there, the big private equity or Wall Street, to say, look, we'll sell you a block of 200 single family homes. We'll sell you a block of 300 single family homes for 25 cents on the dollar if you just take it. Now, I don't know. And also there could be forced divesting here, right? So a lot of times in some of these REITs or some of these big private equity funds, they don't necessarily want to sell, but depending on how the fund structure is, they may need to sell. I don't know. I'm just thinking of if different ways that potentially supply could come onto the market, because as of now, supply is still very low. But a lot of people that I talk to say, look, there's going to be a wave of supply coming onto the market very soon. And I'm just trying to figure out ways how that's possible and just sort of maybe conceptualize it. But what are you guys seeing in the field on your end? Nelson says, Tom, prices are skyrocketing here in San Francisco, California. People are actually moving out from the city. Now that's strange because I think San Francisco is one of the only locations where rents are actually declining. Interesting. The dark horse is yes, total halt in subdivision builds due to interest rates. Now, probably also due to the cost of labor too, right? Hey, Mr. Remy says, hey, Tom, we're building 16 single-family homes in Mount Vernon. Still seeing strong interest and demand. Wow. Well, I mean, that's good news for you guys. It's great. So Mount Vernon is a very nice town in upstate New York. So you're still seeing very high demand in Mount Vernon. So what is your take? I just don't want to I don't want to be disrespectful and pronounce your name wrong. But what is sort of what are you seeing in the marketplace? Do you think that home prices will eventually come down? Or do you not see interest rates having a material impact? Or maybe the single family homes you're building is just catered towards a different demographic? I don't know. I'm always interested to see what everybody else thinks. Daniel, what's up, man? Good to see you. Julian's his most successful campground ever, San Francisco. What's next is my neighbor works for Lennar, and he states sales have totally dropped off so much he is considering selling solar panels. Wow. So Lennar, also, I think Toll Brothers we covered. Sorry about that. I think we covered Toll Brothers when they reported earnings last. And the interesting thing coming out of Toll Brothers earnings was that they actually had to provide incentives to their buyers to not cancel contracts. So they were providing maybe like an upgraded kitchen, or throwing in like an appliance package or something like that, a warranty, just to get customers from canceling the contracts. Not for new business, but just to get the existing clients not to cancel or renege on the deal. Oh wow, Resumes is my neighbor just moved into one of their brand new builds at Mystic. Very nice. Wow, so Mount Vernon is a very strong play due to its proximity to Midtown. That's true. 30 minutes or less, it's a no-brainer. Yeah, and you also get a lot more space too. Especially if you're like a family, right? If you have wife and kids, husband and kids, whatever it is. You know, you really don't want to raise kids in, I mean, maybe the city. Maybe you do, but a lot of people I talk to are saying that have kids, they're trying to, you know, get more space maybe in the suburbs, things like that. Oh, wow. Okay, so Mr. Remy says we develop high-end brownstones in Brooklyn. Exit 2.2 million to 3.5 million. Rates already forced one of our high-end buyers to qualify originally at 3.2 million to down to 2.5 million. Wow. Yeah, very interesting stuff. Some of those brownstones though in Brooklyn are absolutely gorgeous. You know, one of my favorite neighborhoods is a little town in I guess you could call it a town, part of Brooklyn called Red Hook. Now, I think St. Joseph's College is also located near Red Hook. I know we used to play St. Joseph's College back in my college soccer days. And we used to play them at Pier 5 in Brooklyn. And some of those homes were absolutely gorgeous. Like the original brownstones, those were fantastic. Sam Oliver says at least in 2008, they were loaning money. Now nada. So it'll be worse in my opinion. Maybe we'll see. I mean, my biggest concern, as you guys know, is the illiquidity in the debt market. That is my biggest concern. Because if we want to talk macro for a minute, you know, look at the horror show that just played out in the United Kingdom. And the Bank of England said, and I quote, "We are not going to pivot," because at the end of the day, a lot of the other central banks across the globe follow the Federal Reserve's lead, right? So Fed Chairman Jerome Powell. So if the Federal Reserve is tightening, you could pretty much bet that all of the other central banks across the entire world are tightening as well, with the exception of the Bank of Japan. I mean, the BOJ, I don't know what those guys are doing, but so the Bank of England originally was not going to pivot. They were going to continue to raise interest rates right up until Liz Truss and the Conservative Party over there decided it would be a good idea to unveil one of the most aggressive stimulus plans in ever, borrowing an egregious amount of money. And that sent the currency markets of the pound sterling reeling. And you had massive dumping of bonds, or gilts, excuse me, as they call them over there, gilts. So as gilts were dumping, yields were spiking uncontrollably, causing a lot of these defaults across the board of these pension funds that were very, very highly levered towards gilts. But those high leverage strategies for pension funds only work when interest rates are artificially suppressed. When rates go up, those strategies don't work anymore. So the market stopped working. It was a complete liquidity crisis, lockup, margin calls across the board at these big pension funds. So the Bank of England had to come in here and provide stability by buying gilts, suppressing yields, and saving the pound sterling. Now, many people say, well, Tom, that could happen here in the United States. Maybe. But one of the reasons why I don't think it'll happen here is because Does anybody want to guess? Anybody want to take a guess? Yeah, it's because we have the world's reserve currency, right? And the Dixie, I think right now is like what, 110, 111? All right, I really quickly want to show you this before I forget. This is going to be Jamie Dimon's brand new office tower. This thing looks fantastic, by the way. You know, it almost looks like it's snowing. If you look at the top left-hand corner of the screen in the traffic light. Yeah, reserve currency. Yeah, everybody's saying. Yeah, I mean, it's a scary thing, but I mean, we'll see. Hey, Deep Value Alex here from Miami. Good to see you. I'll be in Miami November 1st. This is here in Miami. There's a $1 billion redevelopment of 80-acre Southland Mall site in Miami-Dade County. Construction to start in mid-2023 and will likely have 4,000 residential units. Well, that's good. You know what I can't wait for in downtown Miami? So right across the street from the 200 Southeast Financial Center, and I'm gonna show you guys on the stream when we do our Miami streams, but that's where I work out of, that 200 Southeast Financial Center. You know, Citadel Securities, their satellite office is on the 20th floor. That's sort of their temporary office until they can move into their brand new behemoth building that Ken Griffin is building down there. But if you look across the street of the 200 Southeast Financial Center, you'll see a really, really big, ugly building here. Quick shout out to the New York City Iron Workers. You'll see a really ugly building across the street from 200 Southeast Financial Center. Oh, we gotta kill the spam bots. And they're gonna tear that down and build Bayfront. I think it's gonna be called Bayfront Tower. And that thing is gonna be insane. And there's gonna be a sky bridge connecting, I think it's called Bayfront Tower. It's gonna be connecting it right to the Metro Mover. And you'll also be able to take the Metro Mover to the brand new Waldorf Astoria, which allegedly or supposedly is going to be the tallest residential apartment building south of the One World Trade Center. So I'm excited to see how the skyline of both Miami and New York is going to change over the years. I mean, there's some amazing projects and developments going on. Now, what I'm most impressed with is downtown Brooklyn. Now, just picture in your head downtown Brooklyn 10 years ago and what it looks like now. I mean, totally different. Totally different. All right, let me just wipe the screen here. But if you guys enjoy sort of the topics we talk about on the live stream, if you scan the QR code on your screen and punch in your email, I write a free investing newsletter where we sort of recap what we talk about on the live streams. So we cover not only the US equity market, we cover emerging markets, fixed income, we talk about real estate. Sometimes we talk about cryptocurrency, so if you want to join us over there, feel free to just punch in your email. We're going to start to get back on track with that very soon. But I want to take you guys now to the Seagram building. We're negotiating over a dozen joint ventures, Bed-Stuy and west into downtown. Brooklyn has a lot to go. So you know what? I used to work, and I think you'd appreciate this. You're probably very familiar with the area. And I'll catch up on the chat in a minute. It's just hard for me to read the chat tonight because it's pouring, raining, and I'm holding the umbrella in one hand and my phone in my other, so I can't really scroll. I used to do some consulting with some home healthcare agencies. in East New York, Brooklyn, which is not the best area, but which is very close to Brownsville. But let me tell you something. I am very bullish on East New York. Let's just say that. I think there's going to be a big boom in East New York, because when I went there, I would take the Long Island Railroad. I would get off at Nostrand Avenue, and I would walk all the way up to Gates Avenue. If you're familiar with that, the Gates Avenue subway stop. And the entire block was half broken down and abandoned buildings. And in between every other broken down abandoned building, it was this brand new luxury apartment. So talk about gentrification. So I think East New York is going to be an absolute boom. So I think you're right. That's a good, hey, you know a lot about real estate. Thank you for the perspective here. All right, let me catch up on the chat. I apologize, it's just pouring raining. Hey, Daniel G from Buenos Aires, Argentina. This is the Knicks 115-102. Love that. Is it basketball season already? That's crazy. Line Sync is here. JS is Ken Griffin Citadel. Has investments north of $1 billion. 3 to 4 projects in Brickell. Yeah, I'm very bullish on Brickell. It's awesome down there. I think you guys are going to love the Miami streams too. Now, I think I told you guys this, but the reason why I chose Miami over like Denver, Colorado is just the close proximity to New York, right? And you'll also find out that there's a ton of New Yorkers in Fort Lauderdale, Miami, Florida, and the like. So, you know, even if I needed to be in the city for a meeting, I could wake up at 6 o'clock in the morning, be at the airport by 7, and be at my meeting in New York at noon. I can't really do that in Denver. So, look, I think it's close proximity. There's a lot of New Yorkers. I know a lot of people down there. And it's a very favorable business environment. Now, nothing wrong against Denver. It's just, I mean, you know, I was actually going to go take a job out in Denver, Colorado at a cybersecurity company called Ping Identity. Ticker symbol PING. You know, they were actually just taken private. Ping Identity by Thoma Bravo's by Thoma Bravo, which is Orlando Bravo's private equity firm. Now, the funny thing is, Ping Identity was taken public by Vista Equity Partners. Hold on one second. Maybe we'll avoid there's like a 2-foot puddle here. Maybe we'll avoid that. We'll go up near the Seagram building. Hey, Jimmy's like, I live in Denver. Yeah, I mean, I love Denver, Colorado, don't get me wrong, but I just think for now, it's a little bit too far away, but I love Denver. Very big tech town. Somebody says Denver has a weird airport, does it? Travel niece, this is making me want to move to Miami. Yeah. Hey, Susanna H, thank you for being here. Now, here's the thing about Miami that I will say. Now, I'm not a big party person. I'm not. So I sort of avoid that stuff, but there's, just like New York City, there's a ton of distractions here, right? A ton of distractions. So I guess it just all depends on who you hang out with. If you're focused, you can be very, very successful in New York City and Miami, but there are a lot of distractions. It's a big, big party town, but there are also a lot of people that like to get down to business and work hard. So I think the culture is changing a little bit. I will say New York is a little bit more competitive. It's a more competitive culture. But I think Miami is picking up a little bit of the slack. All right, across the street we have Blackstone. Blackstone actually reported earnings. Let me wipe the camera. Blackstone reported earnings. I think they missed. We'll actually cross. I'll show you guys the building. They reported less than expected net income off the back of declining private equity investments. David is here. Good to see you. Hi, we are on Park Avenue. Now, usually you could see the beautiful 432 Park Avenue from here. The problem is it is so cloudy and rainy. All right, hopefully we won't have to wipe the camera anymore. Let's quickly talk about some notable earnings reports that are coming up this week, because earnings is really going to dictate the trajectory of this market. Now look at this, everybody. You can't even see, holy crap. You can't even see the top of 432. Could you guys imagine living in 432 Park Avenue all the way at the top, and you're literally living in the clouds? That is insane. Wow. Maybe someday, who knows? Anyway, so we have Microsoft reporting earnings, we have Amazon, and we have Alphabet. Now, I'm going to really be focusing on those three specific companies the most, mainly because of their cloud computing units. So many people think of Amazon as an e-commerce company and a delivery company, which you would be right, but I think the larger opportunity there at an Amazon is their AWS service, which is their Amazon Web Services. As you talk about Microsoft, you could think about their Azure Cloud and Google's Google Cloud. And I think those are going to be the main growth drivers into the foreseeable future. Now, I think if we really bomb earnings here across the board at Apple, Microsoft, Amazon, you're really gonna see this market reeling here. And the reason for that is the S&P 500 is a market capitalization weighted indice, which means if you think about a company like Apple, I think Apple makes up almost 7% of the S&P. So the higher the market capitalization of the business or the company, the higher the weighting it has in the S&P. And we pretty much have the top 10 companies that make up the majority of the weighting in the indice reporting this week. So it's going to be very critical to watch out for that. 52nd Street and Park Avenue, everybody. Check this out. This is my favorite building in New York. This is the Seagram building. I got to wipe the camera lens again. But this is by far my favorite building in New York. And I believe the exact address is 395 East 52nd Street. Or Park Avenue, excuse me. And this is right outside of the KPMG building, which is a major consulting company, as well as Blackstone. But this is my favorite building. Now, I told you guys they used to have a company in here called ServCorp, and ServCorp used to be a competitor of WeWork. Well, they still are, but they closed down this location here. I think there's a big investment company in here called Centerbridge Partners. I think they're still here, but the vast majority of this building is vacant, unfortunately. Hey, Junior is here. This is Tom. You're a software tech guy. Do you see the big cloud providers providing a SaaS, expanding as SaaS starts? What do you mean by that? So, like, you can think about that as platform as a service, right? PaaS. But many of them are on subscription-based services, right? Now, if you want to talk about like more like data analytics and like data sorting, I think technically Snowflake I thought it was a bird. It was the guy. Yikes, that was weird. I think Snowflake doesn't technically bill on a SaaS model. It's sort of like an as-use basis, and I think that's better for customers. So if you just pay for what you use, you're not going to be wasting your money. But yeah, I mean that's been the key metric for high growth, is just SaaS and subscription-based models for sure. We got a lot of spam bots tonight. I could have sworn I put on subscribers only mode. Now, here's where I think could be a little bit of a pain point in earnings. And we'll go over each of these earnings reports in detail as they report. But I think you're going to see earnings potentially decline here. Or one of the reasons why earnings are declining is because of currency fluctuations, because the dollar is so strong. Oh my God. So for example, let's say if you're Microsoft and you're selling, ooh, that was almost a big accident. Let's say if you're Microsoft and you have a significant portion of your revenue base based overseas. So you're selling those products and services in a foreign currency. So the problem is when you go to convert that foreign currency back into US dollars, well, here's the bad news. You're going to be getting a lot less US dollars or a lot less bang for your buck, because the US dollar is so strong relative to pretty much every single other currency out there, right? Especially as if we want to start to talk about the Japanese yen, talk about another sort of central bank intervention there. But last earnings season, we saw this same exact thing playing out, right? We saw the CEO of Apple, Tim Cook, come out and say there was a major impact to our revenues and our earnings due to foreign exchange fluctuations. And I think so long as we continue to have this strong US dollar, that's going to be a big sore spot in a lot of these companies, especially multinationals that have a lot of sales overseas. Wow, check out this building, very unique. But if you guys are enjoying the live stream tonight, feel free to leave a like on the video and hit the subscribe button if you're new. We do these live streams about 5 days a week between New York City and Miami, discussing the financial markets, and we'd love to have you guys here along for the ride. Mike says, Tom, did you talk about what happened to US listed Chinese stocks? Well, I was watching the Chinese markets last night and the HSI was getting hammered. Now, I think the HSI alone was down 6% on the day. Many of the individual stocks were down double digits. I think Alibaba, Pinduoduo, and the like were down big. JD, all these Chinese tech companies. And I think that's off the back of, not to get too political, I don't want to get the chat too riled up, but obviously what the CCP is doing, the market doesn't like. Now, I do find it interesting. So this is the Ferrari, I don't know if you can call it a dealership, I'd maybe call it a showroom here on Park Avenue. I wonder why they put it on Park Avenue. Just kidding. Now, one of the interesting things about that though is JP Morgan Chase came out with a statement today and said a lot of the massive sell-off that we've had in the Chinese markets are unwarranted, and this is presenting some pretty good opportunities here. Now, if you look at the HSI, if you type in ticker symbol HSI on like TradingView, I think we cracked the 2011 lows, and we're trading at levels that we were back in 2008. I think maybe even a little bit before. So could there potentially be some, okay, I'll set this precedent. I really don't do any type of bottom fishing. The way I run my portfolio is like a can slim style investor. So you could think about like William J. O'Neill, Investors Business Daily. So I don't bottom fish, especially in Chinese ADRs. Now, I used to have a big position in Alibaba last year, and I sold that for tax loss selling last year, thank God. Had I held on to that position, I'd probably be sleeping under the Manhattan Bridge. But that's why you have risk parameters. But, you know, some people say China isn't investable. Some people say China is not investable at all. Some people say it is. But it also comes down to an ethics issue. And I don't really want to get too political, but do I really want to be investing into Chinese tech companies when, you know, the CCP is, you know, doing what it's doing? And again, this isn't really a political channel, but those are sort of my viewpoints. I know Ray Dalio is a big China bull. And look, I love Ray Dalio, but that's sort of where him and I disagree. I guess it doesn't matter because he's Ray Dalio and I am who I am. Anyway, this is the jewelry store that actually just got robbed the other night. And I can't believe the lightning speed, how fast they repaired this. Now, I think the crooks got away with about $500,000 worth of stuff, which is pretty crazy because I thought all jewelry stores, they put away all the merchandise in a back room after hours. But apparently not. So this is 430 Park Avenue. I actually work out of this building sometimes. It's a beautiful building. And right outside of this building is the very famous 432 Park Avenue right here on Billionaires Row, which I will show you guys now. Wow, that's a really unique shot. Hey, DeLargo is here. Thank you so much for your donation. I appreciate it. It says, hey, why is bad cryptos are still considered securities? Are considered as securities? Well, I don't think the Fed chairman, I meant to say Gary Gensler, the head of the SEC. I don't think he's made his final decision on that yet, but I mean, you guys know my stance on it. I don't buy any of the altcoins. Well, this thing looks like it's gonna blow. Doesn't it? Doesn't it sound like it's gonna blow up? But DeLargo, one of the things that I think is, and again, this is very opinionated, I think the risk is too high to get involved in any of these altcoins because it's very possible that they classify, or the SEC classifies these alternative cryptocurrencies as securities. And that is definitely not something I want to be involved in. Now, if you really think about a lot of these altcoin projects, I mean, you have entrepreneurs, right? Essentially distributing tokens to investors. Now, just because you call them tokens doesn't mean they're not securities, right? So, I don't know. I kind of get the chat riled up on that, but I do have exposure to Bitcoin, but a lot of the other altcoins, I try to stay away. Hey, Herbert is here. It says, Tom, show us your new Rolex you got last week. I'm not a watch guy, and I've never bought a watch in my life. But Herbert, thank you so much for the $2 donation. Herbert, I'll tell you a funny story. I think I told you already. So I got my first watch ever. I've never had a watch in my life, ever. I don't buy like fancy things. I'm just not a watch guy. I'm not saying it's bad if you do. I'm just not a watch guy. But I have a watch, and the only reason why I have a watch is because I was in... what is it called? You're in the wedding party or something? I was in the wedding, and my friend as a gift, he gave me a watch. And I had to wear it to the wedding, and I wore it once, and now it's in a safety deposit box. And I don't even think the watch is worth that much. I think it's like, maybe $300, $400. I appreciate the gift, but I just don't wear watches. Anybody here in the chat know a lot about watches or jewelry? Sometimes I'll watch videos online, and these people are super knowledgeable about all the latest and greatest watches that are out there. It's kind of interesting. Yeah, Juan says, is this open to the public? So this area is open to the public. Now, what you'll notice at a lot of these building sites, especially at the ultra luxury apartments, if you carve out Oh, Herbert, Herbert, thank you so much for the donations as you were referring to the smash and grab. Funny. I appreciate the support, Herbert. Thank you very much. So if you look at these open spaces here, it says open to the public. A lot of the developers on the buildings will get a big tax break if you make a public space, if you carve out a piece of your plot of land and make like a public space. So they did that here at 432 Park. They probably got a really nice break. And they also did that here near the Trump Tower. It's called the Atrium. And I'm actually kind of glad they do that, to be honest, because the Atrium is a really, really nice place. If you guys are in the city during the day and it's a really crappy day and you just want to post up somewhere and work and maybe read and study a little bit, if you go in the Atrium right here, you could do it. And it's open at 10 o'clock at night. So it's nice. It's cool. Love is kind says, any thoughts on the rapid development of AI and how a ton of people, especially creators, are about to start losing slash not getting jobs? Well, we've talked about this before. I think there's a big overreaction and I think there's a big underreaction. Now you may be thinking, well, that doesn't make any sense and that was a ridiculous comment. And I get that, but I'll sort of explain it. Has anybody ever heard of the saying that people tend to overestimate what they can do in a short period of time, but they tend to egregiously underestimate what you can do over long periods of time? Has anybody ever heard that? That's what I think about AI, robotics, artificial intelligence. So here's where I think the vast majority of the impact is going to happen. I believe it's going to come into the category of autonomous vehicles and a lot of automation in warehouses. Now, the interesting thing is, as of right now, you're seeing a big unionization movement across the United States. Now, here's where I think that these employees should just tread carefully. And again, let's not make this political, but this is sort of what I'll say. Because I work in tech and I actually help a lot of healthcare companies put in place like remote patient monitoring services that automate away a lot of tasks. I think if anybody works in software, I mean, software is by definition, automating away a task. Software is eating the world. But I think a lot of people are overreacting to the short-term abilities of AI and automation and severely underestimating the job loss in the long term. In the long term, I mean 25 years plus. Now, there's something called lights out automation as it relates to warehousing. So let's say if you have a big Amazon fulfillment center, the highest level of automation is called lights out. And you guys could look this up. And that is when you have an entire warehouse, there's no lights, it's pitch black, and the robots and the machines do absolutely everything, from the picking, the packing, and shipping. And I think that's coming in 7 years. That will come in 7 years. And depending on how fast, I would really say Elon Musk and his trucks. Now, I think on the last earnings call of Tesla, Elon Musk announced, and could somebody help me out here in the chat? We're going on hour 2 and I'm blanking on the name, but it's called the Tesla semi-trucks. Okay, so on the last earnings call, which was last week, Elon Musk announced that they will be doing their first round of deliveries of those Tesla semis to Pepsi. Did anybody hear that? Now, over the long term, those are probably going to be fully autonomous, right? So think about all the trucking jobs that are going to be automated away over a long period of time, okay? I think it's going to be like 30 years plus before you see big impacts, but it's coming. So I think people are overestimating in the short term, but severely underestimating in the long term, if that makes sense. But here's another thing I'll say, and then I'll stop rambling. I know you guys hate when I ramble. I will say this. I would relax and I wouldn't worry about it because AI, automation, autonomous vehicles are going to make the world a much better place. Okay, a much better place. And for every job that is lost, we'll wait for the sanitation guy to go by. For every job that is lost due to AI, machine learning, artificial intelligence, whatever you want to call it, all the acronyms, there's probably going to be about 2 or 3 jobs that are created from those job losses. And what I mean by that is there'll be jobs available, but these particular jobs will just require a completely different set of skills. So very STEM focused. So this is why I've actually, and you guys know, I tend to be more libertarian, more conservative, but this is actually why I've been open to the idea of some form of universal basic income targeting folks who have jobs in very automation prone industries. Now, the way I would probably set that up, this sort of UBI, is some sort of a training program, or you have to use the money on education to sort of retool and reskill yourself to help you assimilate into a new world economy. Because at the end of the day, if you deploy all of these robots, you're going to need someone to build the algorithms. You're going to need someone to do the maintenance. You're going to need someone to write these algorithms. And that's going to require a different set of skills. So I'm very optimistic. And at the end of the day, think about it like this. So what do you guys think of my idea about this, or my thought process here? Does anybody really want to be doing these monotonous tasks, these very, very mundane and strenuous tasks of working in a warehouse and breaking your back? Could you imagine if that could be automated away and maybe you could be doing something more efficient? I think it would actually make people happier. I don't know. That's just sort of my take. Maybe I'm a little biased about it, but I don't know. What do you guys think about that? Eric says, until the AI writes the algos. Yeah, that's true. Yeah, then we'll just have, then humans will just need a totally different definition in and of itself. Nelson says, I'm learning a lot too, and I got interest in expanding my knowledge in stocks. Well, thank you for being here. Hey, William Brooklyn, what's up? William, thank you for joining in, my friend. We're walking down 57th Street. MSK says, Tom, I think technology is neutral. Mimi says, I don't like UBI. It can be done in other ways to support education. Yeah, I mean, look, I'm just open to ideas, right? I'm just open to ideas because at the end of the day, as an American, I don't want other Americans to be left behind. And I think the main gripe that I have with a lot of our politicians now, and not to be mean, but I think their way of thinking may have applied to their specific time period, but it doesn't really apply now, if that makes sense. So if you have people that, are pushing 90 years old, making policy decision on cybersecurity, AI, machine learning, I just don't know they have the bandwidth to really even understand it. And the reason why I say that is because, did anybody watch way back in the day when Mark Zuckerberg had to stand in front of Congress? And the questions that our politicians were asking Mark Zuckerberg were just, for anybody that knows how to operate a computer or just knows how the internet works or just anything, the questions were so cringeworthy. And it was just like they were trying to make, and now I'm not saying Mark Zuckerberg's an angel, okay? But what I'm trying to say is, you know how when somebody doesn't know what they're talking about and they try to keep up with the high level conversation, and it's just like you have to stop every 5 seconds and explain basic things to them. It's the same thing when the CEO of Google had to testify in front of Congress. And, you know, one of the, I think it was a Republican congressman, was saying, are you tracking me right now? Are you tracking my phone? Yes or no? And he's like, well, it's a little bit more complicated than that. Do you have location services on? You know, and he has to sort of explain it to the guy. It's not just a simple yes or no. Like, you gotta I don't know. Maybe I'm rambling too much, but I think we should appoint experts in those specific industries to make policy on those specific industries. I think that would be appropriate, right? Let's have the smartest people in the world, or in the United States, making policy about those specific industries because they're experts in their field, right? Yeah, that's true. Yeah, they just talk and use a lot of buzzwords and stuff. Edwards says, I remember the CEO of Google had to deflect questions about the iPhone 2. Yeah, I know. They were asking him questions about an iPhone, like how the operating system works, and he's like, yeah, we're not involved in that. That's Tim Cook. You know, speaking of Google, a while back they acquired DeepMind, which is gotta wipe the screen again. So so speaking about AI, that's one of the main reasons why I'm so bullish on cloud computing long term, because you're going to need something that powers this AI. Whether that be Amazon Web Services, whether that be Microsoft Azure or Google Cloud, you know, it's almost infinite, right? Think about infinity. That's how I think about cloud computing. Well, speaking of Tim Cook, he's reporting earnings this week. Now, I will say, just sort of anecdotally here, the iMac with the M1 chip in it is the best machine I've ever used. The best desktop computer I have ever used. So usually my upgrade cycle is about once every 4 to 5 years. So Apple has a really cool program where you can just trade in the device and recycle it, and you'll get, you know, a discount on the next one. Their new M1 and M2 chips is insane. All right, so we're right outside of my favorite building here. This is 157. So the Park Hyatt is right in 157 as well. You can't even see the top, but look at Central Park Tower, everybody. You can't even see anything at Central Park Tower. It's so foggy tonight. Wow. Hey, Joan K is here. Good to see you, Joan. JR is the dark horse, right? We are moving towards an elite type of ruling class, leaving a lot of people behind. Yeah, I mean, I think in generally, I think that technology is making a lot of people's lives better, especially as it relates to healthcare. Right? Look at some of these biotechs now. We are literally going to have the ability to edit away major diseases. That's going to be a reality, right? Like technologies like CRISPR gene editing. We're going to be, in the next 20 years, it is very possible that we could be having cures for major diseases. So I'm definitely not a pessimist. I'm an optimist. So, I don't know. That's what I think. All right, let me show you guys Carnegie Hall. Now, unfortunately, Carnegie Hall is completely covered in scaffolding, but it is one of my favorite buildings in New York. Nader HC says, how many favorite towers do you have? About 6. So my favorite office building, we actually just visited today, which is the Seagram building. My favorite residential apartment tower is 157, mainly because that is the building that kicked off the Billionaires Row trend, I would say. Now, the developers was the Extel group, and funny enough, Extel also developed the building right next door to the 157, which is Central Park Tower. So these are both creations of the Extel group, which is fantastic. A lot of spam bots tonight. I think I forgot to put on subscribers only mode. Apologize. And the other four we will save for when we walk past them on the live stream. I'll give you a hint. One of them is Federal Hall, mainly because that is where our friend George Washington was inaugurated. So Anthony says, why do you like 157 better than Central Park Tower? I don't know, I really like the look of it. And I remember when it was first being built. And I remember watching on the TV during Hurricane Sandy, the freaking crane broke off 157 and started spinning around. It was wild to see. And that was the building that kicked off the entire Billionaires Row trend. And I remember the big headline. I think I read it in the New York Post. I think Bill Ackman bought one of the units there. I'm not sure if he still owns it. I think Michael Dell also. Now, another really cool building that I like a lot is the Trump International Hotel and Tower. And it is so strategically placed that you have an amazing view of all Billionaires Row. That's the reason why I like this building a lot. Now, supposedly, before the Trump organization bought the building, I think it was just regular office towers. Is that right? Could anybody fact check me on that? I think this was just a regular office building, and then they turned it into half the building is a hotel, right? 5-star hotel. And then the other half of the building is residences. And again, the reason why I like the building is because now that they have built out Billionaires Row on 57th Street, well, chances are if you have a south-facing or an east-facing unit of this building, you are going to have the best of both worlds, and I'll tell you why. Because you are going to have a view, an unobstructed view at that, of Central Park and Billionaires Row. You know, if you live on Billionaires Row, you can't really see the skyline of Billionaires Row. You can't really see Central Park Tower if you live in Central Park Tower. But if you live in a tower adjacent to it, you can see all the architectural marvels. 220 Central Park South, Central Park Tower, 157, the Steinway Building, 432 Park Avenue. I mean, it's fantastic. So that's the reason why I like it. Hopefully I didn't oversell it. You know, also the Deutsche Bank Towers is very nice as well. So speaking of Ken Griffin at Citadel Securities, he has a unit in this building too. Hey, the Dark Horse, thank you for joining tonight. We'll see you in the next one. I appreciate you joining. All right, so we're coming up on the 2-hour mark here, so we'll quickly recap what we discussed today on the live stream. Hey, Nelson Sanchez, thank you so much for the $2 donation. That was very kind. Thank you so much. So the main theme of tonight's live stream, the first thing we talked about was a major piece of economic data coming out of S&P Global. So S&P Global reported the manufacturing PMIs, which absolutely fell off a cliff, coming in at a 49.9 reading, when the consensus on Wall Street was for a 51.2 reading. So we're declining faster than the economists are expecting or anticipating. Then we also got the services PMIs, which fell even more, down to 46 from 49.3. Oh, let me wipe the camera again. So the reaction to this news, S&P Global Chief Economist Chris Williamson comes out and says, and I quote, the U.S. economic downturn gathered significant momentum in October, while confidence in the forward outlook has declined rather sharply. So the deterioration in the manufacturing sector and the service sector of the economy is declining rather rapidly. However, you guys know that it's more so the trajectory of those PMIs as opposed to the actual number. Then we talked about some housing data. We talked about how I am constantly getting price reduction emails across the board here in New York. Also, a lot of rentals are coming down too. You know, there's actually a unit in this building that is for rent for $8,500. That is down from $9,500. So a pretty big price reduction there. The only thing that we didn't cover, which I think we'll briefly touch on now. If you guys want to follow along, if you follow me on Twitter at Walks Wall Street. Now, the main anchor at CNBC, Carlo Quintanilla, he tweeted out something very interesting, and this is coming from Goldman Sachs. And Goldman Sachs reports that corporates are on pace to repurchase about $1.1 trillion of U.S. stock this year, which will go down in history as the most share buybacks in the stock market in history, period. A report coming out of Goldman Sachs. Now, why do we think this may be happening? And if you guys have been joining the live streams over the past year, you may have an idea, you may have a clue. So we've been talking about share buybacks, and share buybacks is just simply another way that companies can return value to their shareholders. Now, a traditional way that companies return value to shareholders is through dividends, but the problem with dividends is that's a taxable event. Okay? So if you pay a dividend, if it hits your brokerage account, if it's in, if it's in a taxable account, you have to pay taxes on that dividend income. However, with share buybacks, that is not a taxable event. Companies are taking their excess cash flows and repurchasing shares. And what this does, how it returns value to shareholders, is it artificially increases something called EPS, or earnings per share. So if you're taking cash flows from the business and then you're buying back stock, that reduces the overall amount of outstanding shares, thus increasing the EPS, or earnings per share. Now, one of the things that we like to look for, right, as investors, is companies that can continuously grow their EPS by at least 25% per annum, right, quarter over quarter or per annum. So share buybacks have really taken off. And I remember saying this at the beginning of the year. I'm like, look, politicians are going to catch on. And they want a piece of the pie. So what do I mean by the piece of the pie? Well, they want tax income, right? They want taxes. They want to tax these share buybacks as aggressively as possible. And that is exactly what we got with the Inflation Reduction Act. Okay, so we just recently passed the Inflation Reduction Act, and the last ditch effort from the Inflation Reduction Act was a 1% excise tax on all share buybacks. So if you go to my Twitter, feed, and you see the last thing I retweeted, it was from Carl, the CNBC anchor, and he reported that Goldman Sachs says this is going to be a record year for share buybacks. So do you think that companies are just front-running the share buyback excise tax? Because I think that goes into effect December 31st. So if you buy back a bunch of stock before before December 31st, that's not going to be subject to that 1% excise tax. And then I think we covered a lot today, guys. I think we had a good conversation. I appreciate everybody. Brad's brain says that's not really artificial though, Tom. Yeah, I think you could argue whether it is or not. I think the reason why I say artificial, and again, you're right, maybe I should have used a different term, but here's why I use that term, is because there's a lot of debate on Wall Street to say, how come you're just buying back your stock aimlessly? Shouldn't you be adding to research and development costs? Shouldn't you be investing more into new products and services? Shouldn't you be paying your employees more, right? So I think I'm just trying to make the point of it's a very, very controversial. Now, here's where I sort of do agree with some of the progressives here, is right during the COVID crash, a lot of the airlines went bankrupt. They went belly up, right? And we had to bail them out as American taxpayers. Now, if you look at the behavior of these airlines leading up to the COVID-19 pandemic, they were launching massive share buyback programs. So instead of having the taxpayer bail them out, well, couldn't management have just set aside cash for a rainy day? No, they decided not to. They decided to launch massive share buyback programs, because that is also a key metric into employee compensation, or I would say executive compensation, is share buybacks. Because if you hit specific EPS targets or EPS metrics, that'll make your executive stock options more lucrative if it hits the strike price. But we could sort of delve into that on another stream, because we are running over the 2-hour mark. But everybody, I just want to thank everybody for coming out on this rainy night. I know it was raining tonight, so I know it was an inconvenience for you guys, but you still showed up and we had a great conversation. I learned a lot. We met a lot of cool people along the way, so I want to say thank you all for that. We will be doing a live stream tomorrow, 8:30 p.m. Eastern time from New York. Oh my gosh, we forgot to cover Discover Financial's earnings. All right, we'll do that tomorrow. So, and we'll cover the 3M earplug scandal. All right, so Mike C., thank you for joining. Dusty Cole, I appreciate it. George, Sam, Deborah, Line Sync. If you guys are new here, feel free to hit that subscribe button. Also, if you want to sign up for our free investing newsletter, where we write about the U.S. equity market, fixed income, the housing market, emerging markets, and the like, feel free to scan the QR code, punch in your email, and you'll be signed up for free. I'm wishing everybody a happy and successful and safe Tuesday ahead. I want you guys to go out there and rip its face off, as I always say. So Joan K., appreciate it. Sally, our good moderators, Patrick, New York, Mohammed, Marcy, thank you. Anthony, Joan, Michelle McGraw, Miss Brown Eyes, and to the Mighty Bull, have a good night wherever you are, because there is always a bull market somewhere, and you just need to know where to look. So thank you, everybody, and we'll see you tomorrow. Bye for now.